All right, so Super Investor Index. And just out of curiosity, is that Eric and Lee and possibly John, I guess I'm presenting to?
We actually have a group of analysts in the office here.
Oh, okay, great. Anyhow, so Super Investor Index, this is a presentation I created based on the presentation you guys sent me. So this is just talking about value investing versus the market, right? So whether fundamental analysis and the value investing of Warren Buffett works. So overall, I'm just going to quickly talk about value investing, go into the super investors I picked for my Super Investor Index, talk about the performance, and then the conclusions that I have. All right. So this quote, I just wanted to include this, just really spoke to me about value investing. It's one of Warren Buffett's big quotes, of course, but never lose money, and that I found to be a really, really big cornerstone of all of value investing and the philosophies of it that follow. So, all right. So the first thing that I just wanted to talk about is the difference between value and...
For you.
Oh, please, go ahead.
Yeah, this is Lee. Do you know what Warren Buffett's rule number 3?
I actually don't. What is the third rule?
It's no big deal.
Always listen to the first one, I guess, something like that.
Always listen.
Never lose money.
No. Don't go into debt. That's the third one. So.
Don't go into debt. All right. Well, good advice. Good advice.
Throwing that out. That's a little, yeah. All right.
Thanks. Yeah, thanks. Yeah, no problem. So we're just looking at the difference between value and growth investing here, and just speaking from personal experience, this is actually something that I've and the rest of the fund, which I worked with at Penn State, we kind of struggled with because it's so easy to dip from value into growth when we look at the high potential, high growth potential, and high returns on equity. That we forget sometimes that fundamental analysis has to focus on value first and foremost, right? So, I mean, the very, very simple kind of skeleton characteristics of these is value. We're looking at low price to earnings ratios, price to book ratios, and value investing itself is very, very cautious. So it's another big phrase that gets thrown around is kind of get rich slowly, right? So we're looking at finding that value, finding those bargains, and in essence, I think that's kind of the core of business, right? You're always looking for that sort of bargain, and buy low, sell high is, in essence, value investing, right? You want to buy something at a very, very low price and then sell it later for a higher price. It's a no-brainer, but also very, very difficult when we dig into it. Whereas growth investing, there's actually many likes alike here, but growth investing itself just focuses more on the growth potential. So an investor might be willing to pay a higher price for a company, right? And examples of this might be, say, like high-tech or high-quality tech companies. For instance, a growth investment that we made in the fund would be like ARM Holdings, right? It's a tech company that sold royalties for use of their chips and that sort of thing. Very, very high price to earnings ratio. At the same time, very high growth prospects and very high return on equity. Overall, I'd want to say that, and in one of the presentations you sent me, actually, there's another quote by Buffett that the two of them are joined at the hip. And I think that makes a lot of sense where we look for the bargains, right? Low PE. And price-to-book ratios, but also seek significant growth with those opportunities. I think the combination of the two would be optimal, but I think first and foremost, we have to look at value and make sure that we don't lose money. Any questions before I move on?
No, continue.
All right, great. All right, so just going over quickly what we're up against, I guess, in the market. So EMH, the efficient market hypothesis here, this is definitely the flavor of academics and education. This is exactly what I've learned this previous and past semesters, right? So basically the efficient market hypothesis really just says that you really can't beat the market, right? The weak form is the one, I guess, that most everyone except for, I guess, chartists and technical analysts readily agree with, right? So this is just that, past price history is reflected in the current price. And basically this means that you can't use past market performance to predict the future, right? The semi-strong and strong form is more, I guess, of a theoretical kind of, what's the word I'm looking for, kind of convenience in a sense. It's just kind of there, but I don't really know if anyone actually believes in it because it seems very much disproven. But strong is basically that all information, whether private or public, is already inherent in the market, right, is already priced in. But with insider trading and that sort of thing, you can tell that that's not necessarily it's not accurate, right? Semi-strong is something that's a bit more popular, and it's kind of what we need to accept if we do go into modern portfolio theory, and that just says that all public information and, of course, past price history is included in the current market price. So with that, it kind of implies that fundamental analysis, value investing, reading through company 10Ks, reading through analyst reports, et cetera, all of this would be more or less futile because the market has already priced all of this in, right? So the natural outgrowth of that would just be MPT, right, the modern portfolio theory. And this is kind of the thing that's more in fashion now, especially for portfolio management. There's a lot of assumptions here, including, kind of that we live in a taxless world with no transaction costs, all investors are price takers, et cetera. But the gist of it is that we have to believe that markets are completely efficient, and you can't really construct any sort of portfolio that would beat it. The best you can do is kind of allocate your resources, your capital as well as you can to get the maximum return for your risk, right? There's a big focus on diversification and that kind of appropriate allocation. So in essence, in this universe of all these different assets here, MPT asserts that there's a specific mix of investments that will give you the best upside or that downside risk. And we'll go into that a bit later. All right, so value investing, does it work, right? And here's just Charlie Munger kind of saying you have to value the business in order to value the stock. Another quote that I've actually encountered in the fund. We're supposed to be a value fund, but we face a lot of the same issues that a lot of other smaller funds run into. And that's just kind of the institutional imperative, right? But the first reason that I think value investing seems to work is that, Warren Buffett's argument is very, very strong, right? He certainly has had the past success to really bolster his claims. The test of time, intellectual origin, kind of his arguments that, these were all people that he knew, these super investors. He knew them before they were very, very rich, very, very famous, and they all sort of follow the same Grumman Doddsville philosophy, right? The fundamental analysis, the security analysis approach that Grumman Dodd put forth, and they are wildly successful, and they do have their mutual funds and their great track records to their name, right? So that's one of the big reasons I think that it probably does work. But second of all, this I think was a very, very compelling argument, and a lot of it was in Margin of Safety by Seth Klarman, right? Great book, thousands of dollars on Amazon actually. But so institutional imperative here is. Sorry, what?
Online, Kyle.
I'm sorry?
Or free online. The PDF is free online for you. The first link.
Yeah, I noticed. That's the one you sent me, I think. But I was just amused to hear that the hardcover copy was actually several $1,000s on Amazon. It's like, wow.
I know. It's ridiculously priced.
I'm really surprised why they put it out of print. It seems to be in such high demand.
I need a charity, so that may be hidden. That's what I've heard. All right, go on, Kyle. Sorry.
Right, no problem. So the institutional imperative here, this kind of really perverse, I guess, incentive system of Wall Street. You've always kind of think of it in the back of your head, but Seth Klarman really, really put it out in a very, very user-friendly and very understandable way. As I understand it now, just the upfront fee structure basically means that a lot of these Wall Street brokers, they just have riskless profits, right? You take the fees up front, and it doesn't really matter what happens afterward. And of course, Seth Klarman goes into a lot more about this, but there's so much kind of disincentive here to outperform. Like for instance, brokers are incentivized to churn, right, to make as many trades as possible and to make a lot of big trades for a limited number of institutional clients, right, because they gain the most money this way. And in this sense, the secondary markets are kind of neglected because they're not as profitable, which means that there's still opportunities in that space, right? And in addition to that, so the institutional imperative, of course, also factors into the risk-return relationship. And one of the big arguments that Klarman made was that risk isn't always correlated with return, right? And that's actually very fundamental to the modern portfolio theory and efficient markets, right? But I was reading some more material on this, and I actually found this economist, Eric Falkenstein. I don't know if you've heard of him, but he actually added on to it, and I thought it makes a lot of sense. It's very interesting. And his argument was that, risk and return should only be really, really well correlated if the markets are perfectly efficient. But because of this institutional imperative, money managers don't really have an incentive to ask for high returns for taking high-risk investments, given that all other money managers are also taking these high-risk investments. So,
I have a question for you real quick.
Yeah, go ahead.
Do you think the value investors think that risk and return are not correlated?
Do I think that